How do institutional investors build massive wealth while regular retail traders lose everything in financial bubbles? Most people follow the crowd straight off a cliff. Here is a beginner's guide to financial bubbles and hard psychology. It all starts by understanding a simple psychological framework. Let's look at a basic neighborhood metaphor. Imagine a rare flower bulb suddenly becomes trendy. Neighbor A buys one for $5. Seeing this, neighbor B offers $10 just to own one too. This triggers a massive hype spiral. Suddenly, everyone stops caring about the flower's real utility. They start buying solely to flip it for a quick profit. The price irrationally climbs all the way to $5,000. Then the music stops. One morning, the last buyer tries to sell but realizes nobody else is left. The market completely vanishes. This exact loop plays out on a global scale. Let's look at the modern stock market bubble. It always begins with phase 1, the smart money entry. Institutional allocators quietly buy into an asset with real cash flow or genuine disruptive technology. Eventually, social media and news channels blast the asset everywhere. This triggers extreme retail FOMO. Regular people take out high interest personal loans to buy at historical all time highs right before early investors take profits and exit. To survive this madness, you must understand the ultimate difference between market price and intrinsic value. Market price is driven purely by emotion and scarcity. It is what someone will pay you today. Intrinsic value is driven by math, revenue, and utility. Price is what you pay, value is what you get. When price sits miles above value, a crash is mathematically guaranteed. This disconnect creates a very specific pattern. Let's examine the anatomy of a bubble at peak euphoria. During mania, the asset chart shoots up almost vertically. People invent wild theories explaining why prices will never fall. Here is the ultimate exit sign. When your non financial friends or taxi drivers start giving you aggressive investment advice, the bubble is at its peak. This entire delusion relies on a single financial matrix, the greater fool theory. Imagine 10 buyers in a chain. You willingly buy an overvalued asset for $100 knowing it is hollow. You do this because you assume a greater fool will buy it from you for 200. The game works perfectly line by line until the music stops. Suddenly, you become the terminal buyer. You are officially the greatest fool holding a worthless asset. To protect your capital, follow step number 1. Look at the underlying income. Never buy an asset simply because its price is rising. Strip away the charts and ask, how does this project actually generate revenue? Sound boring. Revenue generation businesses protect you from emotional market corrections. Step number 2. Ruthlessly suppress your FOMO. Missing a volatile market run is a perfectly normal part of professional risk management. Never invest out of panic or late night emotional impulses. A smart thinker buys when assets are hated and cheap, not popular and expensive. You can deploy 3 analytical filters today to stay protected. First, use the utility filter. Allocate capital only into tools or digital equity that clients pay to use. Second, run the cash reserve play. Keep liquid reserves during hype cycles to buy real value at a steep discount post pop. Third, build a skills anchor. Reinvest speculative profits into scaling your independent agency capabilities, which market drops can never devalue. Stop following the herd of the financial cliff. Step back, analyze, and value the math. Drop a comment below with the craziest market hype you have witnessed. And subscribe to the Smart Thinker Club to protect your intellectual operating system.